Hey there, everyone. Welcome to Chart This with Dave Keller. It's Tuesday, July 15th. Welcome to the show. Thanks so much for joining me here. We're coming to you from a beautiful and actually quite warm Redmond, Washington. Interesting day today as I'm, getting the live stream kicked off. I'm just taking one last look at the markets here going into the close. I mean, not a great day, right? Let's be honest. 90% down day for the S&P 500. With 9 out of every 10 S&P names down, 10 of the 11 S&P sectors finishing in the red. The NASDAQ managing to eke out a slight gain, while the S&P 600 small cap index is down over 2%. This is one of those days where it very much feels like a tale of two markets. You see NVIDIA up 4%, Citigroup almost up the same, Super Microcomputer, First Solar, AMD all up over 6%. So technology and some big banks looking actually quite strong, but the average stock looking nothing like that. There are times, and this is why breadth indicators are so meaningful, right? There are times when the market is strong and breadth conditions are strong or buoyant as well. And what that tells you is the market's moving higher and it's a broad advance, right? Meaning most stocks are doing what the market is doing. Then there are times like this where the market's moving higher on weaker breadth, and it gives you a very different sort of look and feel, right? Trend overall still good. Our market trend model still bullish on all time frames, but breadth's starting to look a lot less ideal. We did highlight some breadth indicators yesterday. We will take a couple looks at some breadth readings today. They're getting less awesome on days like this, certainly not helping the breadth conditions overall. We'll look at some of the individual stocks and groups to follow. We'll dig a little bit into financials because we've got a lot of earnings from that particular area of the market this week. Keep in mind Netflix earnings on Thursday, I think pretty important. Next couple weeks, of course, earnings season going to be vital. Let's look at the chart, shall we? Let's get to it. All right. As a reminder, as we're bringing up the charts here, I can see questions that are coming in on LinkedIn, YouTube, Facebook, and X. Appreciate you guys tuning in live. Those that are doing so, please drop questions in the comment section on any of those platforms if you're watching live. I would love to have you. Would love to answer your questions at the end of the episode if time permits. Otherwise, we'll get them into our all mailbag episode on Friday. I'm traveling this week. Just as a quick heads up, tomorrow I'm actually flying to Boston and then going up to New Hampshire over the weekend to do some board meetings for the Walden School, which is a summer music program that I'm on the board of up there. So might do a little different timing on the show this week, depending on how I can slot it in with other things I'm doing, travel and meetings and such. But I will aim to get you a show every day as hoped for. All right, let's get to the charts here. Kind of a strong open, weaker close, right? Coming out of the open this morning, you've got inflation data yesterday and today. And so initial upside for the stock for stocks with the S&P opening right around 6,300, but that was pretty much it. First 30 minutes weak, last 30 minutes weak, everything in the middle kind of weak, top to bottom. This is a pretty rough day. And so indicators sort of rotated lower and got more and more red as the time went on. This is one of those days where it's like watching your soccer team or football team and you're just cheering for halftime or the game to be over. It's like, we're not going to win this game. It's getting worse. Every minute that goes by, I feel like it's going to get worse. We just need to get the team in the locker room and regroup. This is one of those days with an acceleration lower into the close. S&P closes at 6244, slightly below there. That's down only 0.4%. The Dow was down about a 1%, just holding above 44,000 into the close. The NASDAQ, as I mentioned, slightly higher. I mean, we've talked about how technology has dominated. This is maybe the most obvious, glaring example of that I've seen in quite some time. Mid caps and small caps both getting dinged aggressively. You can see the S&P small cap index just falling down through the course of the day, down over 2%. That's your worst performer. The VIX not up by much. It spiked a little bit going into the close, but it's still below 1750. I mean, this is still a low volatility environment. So this is sort of a low volatility sell-off for now. We'll see how things play out through the remainder of this week. Keeping a watchful eye on VIX 20. Anything below that level, conditions are just not that severe. Anything above 20, again, not necessarily the end of the world, but certainly something we want to pay attention to. Looking at the interest rate environment, you can see 10-year yields moving higher today. The TLT was down about 0.7%. Rates generally moving higher. The long bond yield has now pushed just above the 5% level. That happened midday today. The 5-year point pushed above 4% today. It's been below that for a little while. And the 10-year point just below 4.5% going into the close. So chart of the 10-year yield from a technical perspective has certainly rotated from a downtrend to more of an uptrend on the tactical time frame. You're seeing higher highs, higher lows in the 10-year yield, and so rates trending higher until further notice. The dollar bouncing a bit today with the UUP up about 0.5%, 0.6%. Dollar's been weak for quite some time, and again, we talk about earnings season coming up. I mean, the weaker dollar that we've experienced through the course of 2025 tends to have some ripple effects. General things to think about. Any U.S. company, imagine a smaller U.S. company producing stuff in the U.S. but getting materials from outside the U.S. That's more expensive with a weaker dollar, or at least your dollar doesn't go as far when you're buying things outside. For big multinational companies making a lot of revenues outside the U.S., weaker dollar is pretty good because their non-U.S. revenues converted into dollars, converted into more dollars. So that's good. It's more of a tailwind for big tech and big communications names. Certainly seems to be the case. And then weaker dollar tends to be really good for non-U.S. equity markets, right? Because with European stocks, the charts of European stocks generally pretty good, but when you add the weaker dollar into it, it makes them even look even better, right? Just because it's a tailwind for non-U.S. stocks. So a big change in the chart of the dollar all of a sudden starts to disrupt those three basic assumptions. So something to keep in mind if we do see further increase in the dollar here going forward. Precious metals taking a bit of a step back. Gold down about 0.5%. Silver down just over 1%. I'd say both of those charts still in pretty decent shape. I'm not betting against gold at this particular moment. Still own quite a bit of GLD and IAU, and not planning to change that. However, you start to get more of a breakdown in gold, I'd reconsider at least part of that. For now, hanging in there okay. Crude oil prices coming off a bit as well. Looking at cryptocurrencies, Bitcoin coming off of an all-time high, just above 123,000. We covered that on yesterday's show. We've come off a bit from that peak. We're currently right around 117,000 as we're going live here. It's down about 2.5% today. Ether price is slightly higher. Most of the top 10 coins in the red. Latest episode of the Market Misbehavior podcast, by the way, a must listen to. If you have invested in cryptocurrencies, if you've been afraid or insecure about doing so, or if you're anywhere in between, I brought on my crypto expert, at least my favorite one, Adrian Zadunchik. Adrian's an early crypto pioneer, has grown a community of crypto traders, knows the crypto space and knows charts, and I love that combination in a market practitioner. So I had a lot of fun with Adrian, asking him a ton of questions about Bitcoin dominance, on-chain data, off-chain data, a bunch of other things about the technicals, the seasonality. Hopefully you enjoy that conversation with a great expert in the crypto space. If you have others, by the way, as always, that you think would be good for the Market Misbehavior podcast, let me know. Drop a comment wherever you're watching this, and I'm always gathering some good ideas. Had a couple of good ideas on yesterday's show that I'm chasing down, and let's continue on here. Looking at the S&P sectors, only one, and you could probably guess without looking which one that is, technology, up 0.9%. NVIDIA is making new all-time highs today. A bunch of other technology names are going to look pretty green color on the market carpet, although the average color is much more in the reddish hue. So technology number one. Industrials, the second best performer, down 0.8%. Utilities and communication services and consumer staples all done about 1%. On the downside, materials getting hurt the worst today, down just over 2%. Healthcare and financials rounding out the bottom three. Now, financials, that's an interesting one because you got a lot of banks reporting earnings this week. When you have a market that's had the run that it's had, and we're really focused on breadth being an important factor to continue meaningful gains beyond what we've seen so far, I think you look to earnings as an opportunity to re-up the uptrend, right? I mean, this is when a bunch of financials reporting earnings with blowout numbers, that all of a sudden maybe, recharges the bulls, and gets a lot of the doubts out of the way and sort of realize, yeah, these companies are actually growing earnings just fine. This is, conditions are good. That's not the vibe I'm getting from the XLF today, down 1.7%, as a bunch of financial companies are reporting earnings. So keep an eye on some of those sector movements as a critical mass of their members in the S&P 500 are reporting earnings. If there's not a good upside follow through, it's pretty dangerous. Speaking of disastrous breadth numbers, I present today's list of advancers and decliners. A 4-to-1 ratio, looking at the New York Composite Index, stocks down versus up. 80%, 81% of the New York Composite Index in the red, 17% in the green. About a 9-to-1 ratio for the S&P 500, just over 90% of the large cap, mid cap, and small cap S&P members finishing lower today. NASDAQ Composite had the best breadth of all, and it's still not great, 72% going down today. So this was a broad decline. A very relatively small number of stocks managed to finish in the positive, but most things struggled today. Now, keep in mind, as I always remind my premium members, the goal, I would argue, is to make short-term decisions with short-term data, make long-term decisions with long-term data. So am I seeing anything today with this one day's action that tells me, okay, the bull market is over, things are really bearish right now? No. Am I seeing evidence that for one day, the breadth was really weak and a lot of things struggled, and there are signs of weakness that, if continued, could turn into something more significant? Absolutely. So keep in proper perspective. I think a lot of times, and I don't think financial media does you any favors, because every little move is sensationalized. A day like today, you bring out like the big, huge font, sell off, markets plunge and things like that. This was a down day. Down days happen in bull markets. Some of the biggest down days you're going to see are during bull markets and just pullbacks within the uptrend. The question is, do you fail to hold support? Do you break key moving averages? Do you actually rotate lower? And I think that's what you want to be looking for right about now. As the major averages were generally lower, as a lot of the breadth conditions speak to how most stocks did not do well, NVIDIA was up over 4% today. So big US-based chip makers not feeling the pain at all. You have NVIDIA up over 4%, Broadcom up about 2%, Microsoft up just over 0.5%. On the downside, Tesla down about 2%, Meta down 1.5%. I grabbed that Meta chart to take a look at. It's not great. I mean, it's not bad. It's not a bad chart, but it's not a great chart anymore. And I think it's gone from great to okay. We'll take a look at that. You can make your own conclusions about what that might mean for you and your portfolio, but not a great look. By the way, we talked about candle patterns on my Stock Charts TV show this week. We talked about candle patterns and their implications, some of the key ones that I follow. You can find that on the Stock Charts TV YouTube channel. But do we know what this candle pattern is? This is the S&P 500 chart. I'm zooming in on a little bit. Big update, big down day, day two. The down day engulfs day one. There's your hint. This is called a bearish engulfing pattern. We have an up day and a down day. Day two, the open to close range engulfs day one. That's called the bearish engulfing pattern. We had one on the S&P today. What that suggests is that the next 1 to 3 bars more likely lower than higher, which suggests a bit of a pullback in store for the S&P. I'm also noticing, and then I might as well just bring up the actual chart of the S&P in a moment, but this divergence is starting to look more and more clear, in my opinion. Right, we made an intraday high today. We traded above 6,300 for the first time, but the momentum is actually trending lower. So we're starting to get some bearish divergences here in the month of July as we're making higher, but less momentum, less breadth supporting those moves. That's often an early warning sign that things may be starting to rotate. As a friendly reminder, I can see questions and comments that you're putting in on all of those platforms: Facebook, LinkedIn, YouTube, and X. I appreciate you guys tuning in live, those that are doing so. Please drop questions as we go. We'll grab some before the end of the episode. Everything we don't get to, we'll put it into the mailbag. Friday's episode is when I like to dig into some of those mailbag questions with more thoughtful and deliberate answers. Hope to answer your question there. Heat map's not great today, right? I mean, this is definitely a down day, but if you cover up most of the heat map and just focus on the upper left corner, technology wasn't bad. You have random names like IT, like FICO, like Enphase that were in the red, but the average stock did okay. But I think it's less of a broad improvement in technology, and it's more the individual names. So I'm looking at NVIDIA, AMD, First Solar, Synopsys, SMCI. These are all stocks that were up a decent amount today. Broadcom, Oracle, both having pretty good days as well. But at the same time, a lot of stocks in the technology sector were down. It's a great reminder that when you look at the XLK, when you look at the S&P 500, you have to remember that those are cap-weighted indexes and ETFs, right? So the XLK is dominated by NVIDIA, Microsoft, and Apple. Those three stocks are probably about 50% of the weight in the XLK, 45, 50% is an estimate. They're huge, right? They dominate the rest of them. So, I would say most stocks in the technology sector were not great today. As a matter of fact, the average color, the median change is probably slightly lower. We could actually see that by looking at the equal weighted technology sector and see if there are some differences. But for what it's worth, just visually, you can see that, some of the big names were up, but a lot of things were not actually strong today. Also noting, just working our way around the market carpet, Citigroup up over 3% today. And this reminds me of like JP Morgan yesterday. We've got some big banks reporting some pretty rock star numbers, good in the investment banking section, good in the, kind of brokerage portions. But having said that, the financial sector as a whole kind of struggled big time today. Asset managers, as we highlighted on yesterday's show, struggling quite a bit. You can see Wells Fargo down another 5.5% today. BlackRock down today. U.S. Bancorp, some of the regional banks, Huntington, and others getting dinged pretty good, 3-ish%. State Street down over 7% today. So the asset management side, the regional bank side, not looking particularly strong. It's like some big banks looking pretty good around earnings, but the general trajectory of the financial sector this week is not strong. And I think that's a concern. If that's sort of the appetizer for earnings season, this could be a long couple weeks as we digest a lot of earnings that are maybe less ideal, or if stocks are sold off around their earnings releases. After that, I would say, the general experience on the market carpet is a big down day, and it's varying shades of down. I would point out, as I like to on a day like today, when the average stock was lower, things that were up, right? That green color kind of jumps out at you. So I would encourage you, if I'm looking at this and just thinking about where the opportunities could be, I'm immediately drawn to like AES in the utility sector, up about 4.5% today, while the general trend was down. Rockwell Automation, ROK, up 1% today. GE Aerospace, right? A lot of the defense aerospace names have done quite well recently. The geopolitical issues and military actions not hurting that. Tobacco names like Altria up today. So stocks that manage to close higher on a down day, often tells you something might be there, right? And just evaluating them on their own merits and see if there's an opportunity. But today, technology really by far the technology and Citigroup. That's sort of the story of bullish rotations on today's action. All right, looking at the charts here, we'll go through some charts. We'll take a couple questions. We'll call it an evening. The daily chart of the S&P 500, as I highlighted earlier, this two-candle pattern is called a bearish engulfing pattern. It's not good. And what that means, again, it's not a long-term signal. Candlestick analysis in general, kind of by definition, is a short-term set of signals. It's really looking at short-term sentiment. That's why I often recommend, if you're a position trader, if you're more of a long-term investor, don't neglect candle patterns, because understanding that tactical time frame can be super valuable. And I know from working with big money managers, right, you may have a really good stock picking process for overall allocations and thinking about what stories and themes you want to own for the long term, but just optimizing your entry and exit points, thinking about when tactically is a good time to add to a position, or when you may want to wait because there's a pullback happening. That's where short-term charts can be super, super valuable. So recognizing that on a day like today, you have a bearish engulfing pattern, what that implies is that the next 1 to 3 days are probably lower. That tells me probably going into the weekend, I'm thinking a test of the 21-day EMA may make sense here. as we sort of wrap up the first week of earnings. Then we reassess. Then we see what happens. But it does tell me that tomorrow probably not going to be a great day for stocks. We'll see. But that bearish engulfing pattern tells me to think more downside than upside, at least on the tactical time frame, until proven otherwise. Sort of to be determined what sort of divergence, how this plays out. But we're making higher highs in July on weaker momentum. That's something to watch. If we would continue higher, keep an eye on the momentum readings, because new highs on stronger momentum are pretty good. New highs on heavier volume, pretty good. New highs on weaker volume, weaker momentum, weaker breadth, not to be trusted, or generally need to be you need to be skeptical of those moves. We'll keep an eye on that together here. Two charts that I showed you yesterday. I just want to show you how one day can make these charts change pretty quickly. On yesterday's show, we talked about about 70% of S&P members above their 50-day moving average. As of today's close, that's more around 60%. So literally today, about 10% of the S&P members broke below their 50-day moving average. Again, that's not the end of the world. That doesn't tell you that the S&P is going to 5,000 tomorrow, but it does tell you a lot of stocks that have been in uptrends according to the trend relative to the 50-day moving average. That's starting to change here pretty quickly. In one day, 10% of the S&P broke their 50-day moving average. Keep an eye on that 50% level. That's kind of the main one that I follow there. Also here on the percent of stocks above their 200-day moving average. That's still pretty good, because the 200 days is quite a far ways away for a lot of individual stocks. But if we would get more of a corrective move, keep an eye on that chart. For now, the short-term version of that, stocks above their 50 days starting to come down a little bit. We highlighted this chart yesterday, the percent of stocks with a bullish point and figure profile, which what is called the bullish percent index. This one in particular, we're using it on the NASDAQ 100. Although in my own work, I look at the same indicator on the S&P 500 and randomly some other universes of stocks as well. End of the day, this is at 70%, and that's pretty much my cutoff between a euphoric market where almost all the leading growth names are going up, to all of a sudden more of a measured increase as a lot of stocks are starting to break down. Previous market tops have often begun when this indicator goes back below 70%. So I will definitely be keeping an eye on this one through this week and through earnings season. Looking at some individual names, Meta looking more and more like just this classic double topping pattern. The weekly chart actually shows this a little more clearly. I'm stretching it out here on the daily chart. But I just want to show you why support and resistance levels are so important in my process, and I hope pretty important in yours as well. That February peak, that previous all-time high, was around 740 for Meta. We retested that level at the end of June, failed to keep a close above there. So far in the month of July, we haven't touched that level again. Today, we're potentially breaking down to a new 1 month low. I'm looking down at that 680 level. That's the swing lows from June. That's also the 50-day moving average. We'll see if that level will hold. The 21-day EMA, which is often sort of that initial stop in my own work. That's in play this week. And so see if that can hold. But if not, that 50-day moving average and the previous swing lows around 680, that's a level that I'm watching. I'm going to make a note to set an alert on that one because that's an important one. 680, we'll call that. All right, continuing on. Biotech, had some questions on Biotech on yesterday's show. Didn't have a chance to get to it in too much detail. I just want to point out the fact that the IBB has had a brilliant run up to the 200-day moving average. And if you look at what happened off of the April low, we rallied right to a declining 50-day moving average. We tested that a couple times. There, I think, is a pretty transformative move where we find above that 50-day moving average. Look how it starts to slope higher. It tells you conditions are changing. 21-day above the 50-day. That tells us we're now in a short-term uptrend, and we've seen that move persist. What happened in the last week, though, is we have rallied up to the 200-day moving average and failed. So a chart like this, I think, is a fantastically interesting chart if and only if we can get above the 200-day moving average and hold it. And we've been unable to do so. Now we're actually testing the 21-day EMA from the upside after a bit of a pullback here. So right now we're sort of in that no man's land between a declining 200-day moving average and an ascending 50-day moving average. You think of that as sort of the limbo between a bullish market and a bearish market. I would tend to think of a chart like this as a stoplight. I think of anything above 133, green light, that means we're breaking out. Biotechs look good. Below 125, we'll call it, that would be below It's a red light for me. That would tell me to avoid. And while we may end up finding support, I'll patiently wait for signs of accumulation. A breakdown there would tell me we're in a distribution phase, and we're in a yellow light right now between 125 and 133. That sort of methodology, that stoplight methodology, we used that on the S&P 500 earlier this year, served us really well, just reinforcing, okay, as long as we stay above this level, the chart is good. If we break that level, the chart's okay. We break below this other level, the chart's bearish. I think thinking of that framework with positions that you own, with things that are potential ideas, can be just a very simple but powerful way of helping you stay grounded in key movements, as opposed to just using hope or optimism as your investment thesis. Use the actual movements of the market, and I think that's an important sort of a general approach to keep in mind, particularly something like this that sort of rallied and then holding its ground for now. I mentioned the financial sector, not great today as we get through earnings, but Citigroup sort of bucking the trend and popping higher. C making a new all-time high, just above $90 a share on an adjusted basis. It did move just around $92 a share earlier in the day. I think it's a really good chart as long as we hold this structure. Some of these leading financial stocks were above the 21-day EMA, which is above the 50-day, which is above the 200-day. This is what I call the moving averages in proper order, right? They're also, it's price, then the 21-day EMA, then the 50-day simple moving average, then the 200-day simple moving average. That configuration is kind of a long and strong conditions are good. You look for that to start to change, right? So thinking of what sort of deterioration would cause that to break, that's what you should be looking out for. And until then, I think you go more with inertia, right? Something, an object in motion tends to stay in motion. Speaking of objects no longer going in the right direction, Wells Fargo, and the other side of this is some of the asset managers, some of the banks that I would share with you. The charts are looking a little less ideal. This is what can happen to the chart of Citigroup on a big down day, is all of a sudden we're down 5.5% on Wells Fargo. We've now broken below the 21-day EMA. Now the 50-day moving average is looking pretty close. We've had a number of tests of the 200-day moving average over the last year. Every one of those has resulted in a pretty buyable dip as the market has soon rallied back above the 200-day moving average. So I think these levels of support are pretty meaningful. If I did have a position in Wells Fargo, and I don't right now, but if I did, something like breaking the 21-day EMA for me is often sort of an initial level. It's maybe where I don't unwind everything, but maybe take a little bit off the table, take a partial close of the position. You lock in some of those gains. We deteriorate further, that's when I would start to unwind a little bit more. The chart of Wells Fargo, by the way, is really coalescing around that 72 level. And I'll tell you why. This is the 200-day moving average is currently just below that 72 level. And so I think that's an important one to watch. If you look to the left, you can see that lines up with the June swing low and the May swing low and the lows from early May. And there was really sort of a little gap there as we accelerated off the April low. So that's a level, what we call a pivot point. This is a level that has meaning, and we're lining up with the 200-day moving average. This is one of those, as more of a long-term investor, I'm kind of seeing anything above 72 is pretty decent. I may even, take a shot at a chart like Citigroup or Wells Fargo, that is, as we get down to that 72 level. But you want to watch certainly and keep a close stop in mind, because a break below the 200-day can often turn into something way more significantly negative. This is an example of a chart I'd probably be avoiding. This is the insurance ETF, right? So we've got banks, you've got regional banks, you've got insurance. The three sector spider ETFs I think are really helpful to watch in the financial sector. That's KBE for banks, KRE for regional banks, KIE for insurance. The KIE now looking the less good out of those three, breaking below the 200-day moving average. So I think this sort of chart, this is the kind of chart I would be avoiding until and unless we can regain the 200-day. That's one of those like basic litmus tests. Until that happens, I'm probably avoiding this as the relative strength is deteriorating and we're failing to hold a key moving average. So like back here at the April low, a week later, we're getting back above the 200-day. All of a sudden, that starts to look a little more interesting again. But for now, I think a breakdown of the 200-day is a cause for concern. Home Depot is one more that I'll share with you. Home Depot failed to get above the 200-day in mid-March, now failed to even touch the 200-day in the month of July, breaking down below the 50-day moving average today. If you draw a trend line off the April low and the June low, it's kind of just below today's close, but not by much. We're kind of testing trend line support as the RSI is testing 40, much below this level. I think that's a pretty negative rotation because you have the failure to get above the 200-day. The 200-day now sloping lower. We're now failing to hold the other moving averages. We have weaker momentum and weaker relative strength. That's the kind of chart I would be avoiding. So if those are the charts that are struggling, where are there interesting charts? The good news is, one of the things I found over the course of my career, regardless of what's happening in the macro environment, some chart somewhere is probably breaking out. This is why scanning tools, using technical analysis features can be very, very valuable, because it just helps you identify constructive charts if you're struggling to find those. AES came up on my screen of stocks sort of breaking out, making a new 3-month high today. I like the fact that we're back above the 200-day moving average, given the fact that we're rotating higher, pushing above the 200-day. As long as that holds, that means improving trend, improving momentum, improving relative strength, and a decent dividend yield. This is a stock that's still paying over 5% dividend yield. So compared to your local friendly treasury bond, it's a better payout and a more constructive price action with some capital appreciation baked in as the price improves. Interesting chart. Not all utilities look this particularly strong at this moment, but that was one that came up on a screen and wanted to share with all of you. All right, let's take a couple questions here as we wrap up. A lot of great questions I'm seeing on YouTube, on X. I'm not going to get to all of these, but I can't tell you how much I appreciate that. And thanks so much for watching. I'm going to take a couple. Chuck, thank you for watching on the Facebook. You said, would love your comments on WMB. Do you think the longer candle tails of the last week are a bullish sign? Thanks for watching live on Facebook. I appreciate you doing so. WMB is Williams, which is one of the, when you think about the energy sector, we often kind of think of it, or I think a lot of people kind of oversimplify and think of it as oil companies. And there are obviously a lot of big oil companies whose fortunes are really tied to the chart of crude oil prices. But Williams is not one of those, right? Williams is a different style. This is more energy infrastructure, sort of the way that oil gets from wherever it comes out of the ground or the water to someone's gas tank, and sort of that logistical side of it. And pipeline companies have been much better than integrated oil companies in 2025, generally speaking. Now, July's changed a bit because Williams and others have pulled back a bit, while some of the other energy stocks rallied pretty aggressively over the last couple of weeks. Now starting to settle back down a little bit. To your question in particular, I think with Williams, it's still okay. It's like an okay chart, right? We're not in an uptrend where we're above all the moving averages. I mentioned the moving average proper order. It's kind of not there yet, but we're still above the 200-day moving average, which is sloping higher. So I would think of this as like an okay chart with some general long-term strength to speak of. With a lot of the pipeline companies, they can pay some pretty healthy dividends. Williams is okay, right around 3.4% based on the current price action. But that's something that, with a lot of pipeline companies, the dividend can actually be significant. So I would definitely think of this as a total return type of play of, potential for price improvement, but also the dividend component, what we call the income side of things, doing pretty well. Particularly you asked about what we call the long, you mentioned long tails. We call these long lower shadows, would be the technical term I would probably use for that. Is that bullish? It kind of is, right? These candles here, this one in particular looks like a hammer candle. It's going to look a little more clear if I switch it to a candle chart. Like, this is what that looks like. An ideal hammer candle would be little to no upper shadow and long lower shadows. I don't know if those are perfect textbook hammer candles, but this one certainly close enough for me. That implies accumulation, right? Think about what's happening, right? We have this big sell-off day. We have about another week of going lower, and then we have 3 days in a row where we open, we trade lower, but then we close back more toward the highs of the day. It's pretty encouraging, and that suggests that buyers are coming in kind of in that 56.50 to 57 range and pushing the prices back higher. So we're kind of rallying a little bit off of those long lower shadows, as I would call them. We're pretty close to what I would consider a classic entry point in this kind of chart. A break back above the 50-day moving average usually indicates a resumption of that uptrend, or maybe a retest of those late June highs. So, if you've sort of pulled back on a position because you're waiting to see, I think a break above the 50-day, that's kind of where I would generally look for a tactical entry point to look for the uptrend compared to other energy stocks. So I would say energy infrastructure, great long-term play whether or not crude oil prices go up, there's a lot of need for improvement in that particular space. It's kind of a long-winded answer. Let's go to Milt89 watching on YouTube. Hey, Dave, you recently mentioned that some asset managers must stay invested and will rotate into different sectors. Approximately what percent of the money, et cetera, in the market had to stay invested? That is a really interesting question and a thoughtful one and a really tough one to answer. The honest answer is you have to make a lot of assumptions. If there's one thing I miss about working at a large financial institution based in Boston, associated with the color green, is that we had a ton of internal data, which I enjoyed looking at, but now I miss it because we could see all sorts of detail about which of our funds were buying and selling different names. We could look at the bets that the house as a whole. I mean, it was a huge operation when I was there. And we had just under $1 billion just under $1 trillion in assets, just in the equity markets. Now it's all grown significantly even since I left in 2016. From there, it's just gotten bigger and bigger in a lot of ways, for sure. And the market appreciating and making all-time highs, certainly a big part of that story as well. But I loved looking at just the internal data that we had about flows, about trading. We could really analyze our entry and exit points and do a lot of back testing and stuff like that. The trading desk had a lot of really good color from good relationships with brokers and so forth. So I desperately miss that because that actually we would have hard data, at least internally, about how much cash we were holding and who was trying to get defensive and who was not, and start to think about that. Broadly speaking, there are some things you can use. There used to be some really good data about cash positions. The problem is this whole zero interest rate thing kind of killed that as an indicator. Back in the day when rates were a lot higher, as a money manager, it would really pay you to go into cash because you would have a decent return from the cash. It's not the case. I mean, it is to a degree, but not as much as it was. And so, cash position, mutual fund cash positions, I think, was a really good indicator. Now that's changed a lot because ETFs are getting a lot more flows in mutual funds in a lot of ways. And people trade mutual funds very differently than they used to. So I think that as a data set, a lot less helpful. That's a long-winded way of saying I don't really know. What percent of the money has to stay fully invested? I mean, generally speaking, large money managers, big mutual fund companies, their mandate, if you look at the prospectus of a big mutual fund, most likely it's fully invested, meaning they can have a little bit of cash for like sales and redemptions, but most of it, has to be fully invested. That's kind of an older model, though. Hedge funds obviously don't have to be a part of that, and any sort of RAA or separately managed accounts obviously can be much more independently minded about how they manage cash positions. So it's tough to generalize at this point, to be honest with you. But I do say I will tell you that big money managers still have a ton of capital that they're floating around. There's a lot of money in 401k accounts that aren't moving anytime soon, that are going to be in there for probably decades to go. And so as a result, it's still worth following. And that's why looking for defensive sectors and when they improve still has value, because there are a lot of money managers that would be looking for that. Boy, let me ask her one more. Zach, thanks for watching on X. I saw you put a comment in there, and I appreciate you tuning in live. Do I have a favorite technical analysis book? Now, a cynical person like me would say Breakthroughs in Technical Analysis, edited by Dave Keller, published in 2007. But I will very humbly and with 100% honestly tell you, it is nowhere near the best book I've seen on technical analysis. I would actually grade it very low because I wrote it a long time ago. I feel like if I would redo that book today, I would have a totally different approach. It's probably way more informed just because I've been doing this for almost 20 more years than when we published that book with Bloomberg Press, which is now part of Wiley. So having said that, I have a website, Market Misbehavior. That's not how you spell it. marketmisbehavior.com. And if you go to the website, click on reading list in the upper right corner. Those are the recommended books that I have. This all uses Amazon links. So if you click through, it helps me make Market Misbehavior awesome, which I wouldn't mind. But this covers key books I would follow in different categories: general investing, market strategy. You were asking about technical analysis, and I think of that in like 3 different buckets. One would be kind of classic technical analysis books these are the ones to get. I would look at the Edwards and McGee book, which is like the Bible of technical analysis. Fantastic treatment of price patterns, general concepts. This is written in the mid 20th century, but so much of what they wrote about still absolutely relevant because it's all playing on investor behavior. I would also encourage you to read up about momentum, and I think Gary Antonacci's book called Dual Momentum Investing is fantastic because that talks all about quantitative ways of measuring momentum, how to manage a portfolio using that concept in technical analysis. And then finally, I would read up on behavioral finance. I think technical analysis works because it's a way of quantitatively measuring investor psychology. Read like A Rational Exuberance by Robert Schiller. That's a really good book talking about the behavioral implications of bubbles and busts, how the charts make sense when you look at market history through those lenses. So check that out if you want to look at my recommended reading. Those are the books that I would recommend in some of those areas that you asked about. Some other great questions we're not going to be able to get to, but I promise I will put them all in the mailbag, and I'll hope to answer one of your questions in our next all mailbag episode, which will be on Friday. Tomorrow is a travel day for me. I'm heading to New England, going to Boston to meet with some people and to hang out in the city, and then drive up to New Hampshire to serve on some board meetings over the weekend at a music school that I love called the Walden School in Dublin, New Hampshire. We'll be coming back on Monday. So I'll keep you updated through social media if I'm going to be changing kickoff times for the live stream, but I appreciate you hanging with me as I travel around the country and talk charts with people. Have a great evening. And remember, it's always a good time to own good charts. Take care, folks.